Welcome, everyone. My guest today is data journalist Will Robinson to talk about housing forecasts for 2024, and specifically what to make of mortgage rate forecasts in light of how fast things are changing. Will, welcome back to the podcast.
Thanks, glad to be here.
Great to have you here on a very timely topic, which is forecast for the new year. And I mean, wow, it has been such a crazy year for forecasts. And then even in the short time that we've been doing forecasts in last month, I think things are already broken. So let's back up a little bit and talk about your Data Digest story that you did, where you looked at different forecasts. Who did you choose to look at?
Quite a few. So there are obviously a lot of different groups who have a vested interest in how housing does and keep a close eye on it. And so there were a whole host of forecasts that we could have parsed through. We ended up trying to just show the ones that made available their quarterly forecasts. A lot of groups just do annual, so we were trying to track a tighter look on how the whole year looks. And so for various indicators that ended up being Fannie Mae, Redfin, National Association of Realtors, Mortgage Bankers Association, and Wells Fargo were the majority of them.
I like that distribution because you do have, you have Fannie Mae, who obviously has different data maybe than the National Association of Realtors is looking at, right? So you've got Real Estate Association in there. You have Mortgage Bankers Association. You have one of the largest lenders in the country, Wells Fargo. So it feels like a good representative set of forecasts.
Mm-hmm. Yeah, it was a pretty good sample, I felt like.
So what did they let's walk through what it looks like. The most contentious, of course, or the thing that's going to be the hardest is mortgage rates. Like really, like, God bless people who are even willing to do a mortgage
Yeah,
rate
to put a
forecast at
number
this
on a
point.
paper and say, this is what I think.
Because
Yeah,
I mean, this last year, I mean, people did their best, and it was there's no way to predict what the Fed did. I don't think, and so after that experience, I'm very interested to see what they said about mortgage rates this time.
yeah. So universally, the picture is better. So they're expecting lower mortgage rates, especially by the end of the year, and they're expecting kind of an inching rate down through the first half of the year, and then a steeper rate down in the second half of the year. But all of the ones that we looked at, the forecast for the whole year ended up still above 6%. Not a lot above 6%, but still above 6%. And so the tricky part right now is that for the first quarter, the average was still above 7%. So the average of the four that we looked at were 7.28% mortgage rates for the first quarter. And obviously we are currently below that right now. So that is an interesting development since those. I mean, and these are kind of various ranges. NAR does theirs quarterly, so their last full quarterly projections were at the end of October, and then most of the others were mid-November, and I think we had one the first week of December. So these were all before the Fed meeting, and NAR's was the furthest away in time from right now.
Well, and I mean, you can understand. I mean, so NARS was pretty much closer to 8% than where we are today, right? And looking at that, and at that point, the Fed was still talking pretty hawkishly about what they thought the future looked like. So again, understandable that it was hard to predict what was going to happen.
It's true. I will say though, for NAR specifically, they do a good job in their quarterly when they break out like every single number, and so they do have their own predictions of the Fed fund rate that was available in the quarterly one for October, and they did forecast even in the October one 3 rate cuts next year, even back then, and they had their 2024 look ahead summit this last week, and it was the day before the Fed meeting, and at that point they were predicting 4 rate cuts next year. So that was priced into their, or modeled into their expectations, but yeah, that was a while ago as far as expectations.
So walk us through what it looks like specifically, and then what you think we should take from that, given that we're already below those numbers today.
Yeah. So in general, I would say the vibe from all of these forecasts is next year is going to be better, but probably only a little better. It was more of, I guess, the optimism is in the sense that 2023 was rock bottom, but not that next year is going to be a banner year. So again, the general expectation is that rates are going to stay above 6% all the way through next year. So that would still help inventories, and that would still help buyer affordability a little bit. And so there's a general expectation of more existing home sales, and that's anywhere from like 3 to 7% more than last year. There's a higher expectation that new home sales are going to continue to do well just because there's more inventory and there's more inventory in the pipeline, and you're still seeing that mortgage rate lock on people not willing to put their houses on the market right now. So just with the inventories being better, with new home sales, there's a higher expectation that both in pricing power and in just overall sales, that new home sales are going to continue to do better than existing home sales. Home prices, the expectation is they're either going to be flat or a little lower. So like tops 3% lower than they were this year. And obviously we've set multiple records for all-time highs this year. So not expecting huge changes in prices at all from any of the forecasters, at least for the existing home prices. And then home construction it seemed like out of the ones that we could get quarterly numbers for, it was kind of just throwing a dart at a dartboard. We had out of the ones that we're guessing, there was one that was way higher, one that was way lower, and two that were basically the exact same. And then the average of that would obviously be about the exact same. So builders, we've talked about this in previous data digests, we've talked about on here, builders are still at higher levels than they were pre-pandemic, but that's kind of flatlined. At that, they're maintaining that higher level, but it's not growing anymore. It's more plateaued. And so I guess you could say the takeaway from that is more of the same for next year is kind of the expectation.
Interesting to see how all of these work together. Obviously, like you said, mortgage rates drive everything else that's going to happen. And from my perspective, one of the most interesting things is the home prices, which you mentioned, because if mortgage rates dip, I feel like that, demand is going to go up. I don't think inventory is going to potentially match that demand. So then home prices, which, are just still pretty high. To your point, I mean, no one sees it like, oh, home prices are going to fall 20%. So or 40%. So we're back down to 2019 levels. I mean, nobody sees that happening.
No, I mean, you hit the nail on the head. That sounded like almost verbatim some of the reports that I read on their forecast. And exactly, the mortgage rates that's what's the key touchstone in all of the different forecasts is what our mortgage rate's going to do. And just to kind of like share some perspectives on that, Lawrence Yun, the chief economist for NAR, he spoke with our colleague Sarah Marks, and he said the story this year and the story next year depend on two variables: mortgage rates and inventory. And then you have other people chiming in, which I'm sure Lawrence Yun would agree with, that mortgage rates are a big part of inventory because people aren't putting their homes into inventory because of the difference in the mortgage rates they have and the mortgage rates they could get. So you have Morgan Stanley saying, as rates come down throughout the year, you would expect one, affordability to improve, and two, for sale inventory to increase. And then just this last one I'll add is from Moody's Analytics. Higher mortgage rates are the main reason for the low level of sales. Lower rates will spur additional activity, but sales are unlikely to rise appreciably until rates fall closer to 6%, which the forecasts are not saying is going to happen until Q4 of next year. So it kind of reinforces that, one, mortgage rates are really what's causing all of these ripples in the market that we're trying to forecast for this upcoming year, and that unless you get way lower mortgage rates, you're not going to see dramatic changes in these things. You're looking for incremental changes in home sales and home prices next year.
And all of that, I think, makes total sense. I mean, there's just the affordability part of this is, it's the overall picture. And so home prices, mortgage rates together really, determine, like, can people afford this house? What's the demand going to be? And, so that makes all sense to me. So, but let's talk about now. So that's the story that you wrote about and did a great job doing data visualizations for last week. It's a whole new week, Will. So it feels like some of those predictions, we just need to go, okay, that might totally change. So how are you thinking about it this week after the Fed meeting and seeing what happened?
Yeah. So again, looking at our mortgage rates ones, I averaged it for the ones who gave us quarterly projections. 6.62% was the average expectation for Q3, and as of Friday, we were at 6.69. So as of Friday, we were basically at the Q3 projection for next year. And even the day before the Fed meeting, when NAR did its presentation, its expectation for the full year was a 6.3% average rate. We're not too far from. And if you go from the beginning of last week to the end of last week, you go from 6.99 to 6.69. So that's a pretty big jump. So there is the potential urge to like, okay, well then they're already wrong. Let's just chuck all of this in a bin. And I would say, slow down a second. So one of the things is that the anticipations lead the Fed. So before the Fed actually raised rates, there was an expectation that the Fed was going to raise rates, and so mortgage rates rose before the Fed made changes. I think you're seeing a similar effect. There is the expectation now that the Fed is going to cut rates, and so mortgage rates are falling before the Fed cuts rates. But what you had in the meeting from last week was expectations. That was not a schedule of we are going to make this many cuts, we're going to do it on this dates. Those are all expectations. And I would point out around this time last year, you had another kind of peak to valley nosedive in mortgage rates. So you went from in November 10th, 2022 to February 9th, 2023, the weekly average rate for the 30-year mortgage went from just over 7% to just over 6.1%. And then obviously it went back up. So these are quarterly projections of full year projections. And so you don't want to get too swayed by what happened in a week when you're looking at that kind of time scale. And I would stress kind of some of Jerome Powell's words. So these projections are not a committee decision or plan. And he also said no one is declaring victory. That would be premature, and we can't be guaranteed of this progress. And then you had the New York Fed President, John Williams, on Friday, after Jerome Powell spoke, say, we're not really talking about rates yet. And it would be premature to be thinking about March, which as of right now, a lot of these expectations are assuming the first rate comes in March. So these are all forward-looking things, and we don't know what the future is going to be. So everybody's going to be at least a little bit wrong, and we don't know to what degree who's going to be more wrong, who's going to be more right. This is all kind of forward-looking. And it's not just mortgage rates that we're seeing this like, we made it, it's going to be a soft landing, the Fed's coming down. Like, you saw this across the economy. So you saw tech stocks bounce back, you saw real estate and banking stocks bounce back. There's just this kind of shared consensus. And I think a lot of it is just that everybody was so hungry for any good news about fund rates at all that it was like, okay, now really the intention is cutting, everything's back to good times. And so I think you could see a bit of a correction soon, in the sense that there's, optimism can turn to exuberance, and so we just don't know. And so I think a lot of these projections all of the forecasts that are in the data digest from last week had the assumption in them that the Fed was going to cut rates multiple times next year. So that did not surprise the forecasters that the Fed would be cutting rates next year. So whether the forecasts are right or wrong, they were not blindsided by the idea of rate cuts next week. And I would stress just maybe don't put too much faith in the movement of a single week when you're looking at a full quarter or a full year kind of projection.
Well, and it sounds like what you're saying is, it's not like, it's not like March Madness where like, okay, you get your bracket broken in the first week and you're like, okay, I'm totally off. We could just throw it out the window. That even though in the first week we saw some really unusual things happen, especially in like the fact that we're in like 6.6 whatever already, that doesn't mean that you can just throw out the whole projections.
Yeah, and the Fed's saying the same thing. The Fed is saying, we're looking at the same data you're looking at, and that data is encouraging. If the next round of data that we look at is not encouraging, then we'll do something else. And that is one of the things Powell said multiple times, is that we still have that arrow in the quiver. So we expect that we are at or near the peak of rate hikes. But if we see different numbers, we have not taken increasing rates off of the table. That is still on the table. So we still are all going to be watching the inflation data. We're still all going to be watching the jobs data. We still have to see. And again, just kind of like contextual, I guess, way of thinking about it. James McIntosh, who's a senior markets columnist for Wall Street Journal, was kind of just talking about the totality of everybody jumping back into rate sensitive things, and just kind of that like, oh, I guess we're fine now. He said, okay, well, if you look at this exact time last year, you had a similar consensus that we are barreling towards a recession, that we're 6 months away from a recession. And there was a lot of market behavior based on that expectation, which then we didn't get. So his column was basically just beware consensus. So just because there's a consensus at the moment does not mean that that is what's going to happen. So really it just stresses, I guess, that we need to keep looking at the same numbers that we were looking at this whole year. We need to keep looking at inflation. We need to keep looking at what the Fed says. We need to keep looking at jobs. And we need to keep looking at the 10-year yield and how that is differentiating or not differentiating from mortgage rates and a lot of the same things. And to be fair, that's what a lot of the forecasters, that's what all of the forecasters were looking at when they made their predictions for next year.
I like it. No, and I would say, our lead analyst, Logan Motoshami, definitely, he felt like there was an inflection point several weeks ago, and felt like, he expected the Fed to be able to not pivot like that, to change their tune a little bit to that point, and he does expect the inflation data to keep getting better. But again, we'll have to
Fingers
look at. I
crossed.
know, fingers
Yeah.
crossed. We would all like that. I think we had 12 to 15 weeks last year, as you said, that were really that were positive, and so purchase application data went up. We just saw this big bump, right, which made for a nice spring because people, or early spring, because people jumped at that rate. And it's also just the psychological feeling of like, before 6 point whatever wasn't, that attractive if you're looking at 3, but if you went and you looked at 8, you're like, I better jump in at 6, whatever it looks like. So it's so weird
Yeah.
how that changes.
Yeah, it's totally fair. And yeah, I think there's some optimism, even if rates stay high, just that people need to move. Like there's just too many life events for you to never sell your house again. And so I think there's some optimism that there would be some higher sales than next year, which is why the consensus estimate is that 2023 was the rock bottom, that there's still going to be more inventory, even if rates are in the 7-ish% range. And so seeing rates come down early is definitely more encouraging. And so I'm not trying to totally rate on the parade. It is encouraging to see that. And we would love for it to stay down there. But this is a full year look that we're trying to do, and we don't know what's going to happen in a full year, because obviously the 2020s have shown a lot of different things can happen in just 1 year.
So let's talk a little bit about home sales and what the total number of home sales we're expecting. Again, referencing Logan, it's rare for in the U.S. to have less than 4 million home sales in a year, just because of the sheer number of people we have and the people who need to move for various reasons, not just like, oh, I want to, but like they need to. It usually, if you look, historically over the last couple of decades, it's about 4 million. It can get much higher than that, but what are the projections for 2024 there?
So for existing home sales, we did on the quarterly figures, those are the seasonally adjusted annual rate of homes sold. And for that one, you have Q4 starting out either just south of 4 million or just north of 4 million. And then you have a much wider range by the end of the year to NAR being over 5 million at the high end and Fannie Mae being 4.2 million at the low end. I believe the figure that NAR put out this last week for the full year was 4.7 million. We definitely we're going to be looking at other forecasts and kind of we're going to keep looking at forecasts for next year. We're still rounding up some of the ones that were full year look aheads. This last data digest focused on just the ones that did it by a quarterly breakdown, but typically what I saw was between the 3% increase in existing home sales to tops around 12% existing home sale increase. So somewhere in that range of low singles to just around 10% of the increase in existing home sales.
So interesting. So more than 2023, but not like blockbuster.
Exactly. Yeah. But there were a few that were brave enough to venture into 2025 forecasts, and it continued to get rosier. That's still predicated on the same kind of stuff that you're seeing out of the Fed, which is Fed rates starting to come down in 2024, continuing to go down in 2025, continuing to go down in 2026 to the point that you're seeing 2.8% or 3% as the Fed fund rate further on. And so this is supposed to be, so based on those kinds of expectations, you're seeing next year as basically the beginning of a rebound in home sales. So yeah, not a banner year, but on a good trajectory that should continue to get better if inflation numbers continue to get better, if the Fed fund rate continues to get better, that kind of thinking.
So interesting, because over the weekend there was a lot of exuberance, as you might say, and saw a lot of people who were not only talking about the fives but even the fours. And so there's plenty of people on the internet that I do not listen to, but these were not
Yeah,
even like, these weren't like far out people nobody's ever heard of. And I was like, wow, that's interesting. So we're gonna have to
yeah.
see.
Because I had CNBC on when after the Fed meeting, and it was like at one point I want to say it was 89% of the S&P 500 was up on the day. It was just that the exuberance was just everywhere. It was everybody was excited, and even by the end of the day, that had come down a little bit. But it was, interest rates impact a lot of things. Obviously, they impact mortgage rates, but they impact a lot of things. And so you're seeing a lot of optimism, I would say, in everything that interest rates touch right now.
So I'm so glad that you did this analysis now at the end of 2023, because then we can keep checking back over it and do
Exactly.
more data all through next year. Was there anything about the data that you looked at the different forecasts that surprised you?
I think it was maybe um, that in general, NAR seemed the most optimistic about most things, but they seemed the least optimistic about mortgage rates going down. So even though they had some of the higher expectations of mortgage rates for next year, they still expected the most sales. They still expected the most new construction. So it just seemed kind of interesting. You would think it would be the opposite, that then they would also be the most optimistic about mortgage rates going down. But um, I think I think in general, most of the forecasters were kind of on the same page. I think where you had the least consensus was on construction and the pace of construction. But in general, I think it was reassuring, I guess, to see that the forecasters were kind of all on the same page, because it gives you a little more confidence in that guess being somewhere near how things pan out. That mortgage rates are going to be lower, and home sales are going to be a little bit better, and home prices at least aren't going to get worse. Was kind of, I guess, my takeaways from it.
These are good silver linings. I appreciate that. I think everyone in the industry needed some good news going into the holidays, because it has been a brutal year in many respects. Even people who have really, figured out a way to make it work and are doing okay. I mean, it's not been a banner year for anyone that I can see. And so, good news all the way around. What are you planning for this week's Data Digest?
I think it's going to be a little bit of a deeper dive at this, a little deeper dive at, what were the predictions out of the Fed? How does that compare to recent predictions that they have made? How have mortgage rates moved in tandem with some of these Fed meetings in the past, and how different does this week look compared to those weeks? And just kind of try to contextualize this this move that we're seeing in mortgage rates recently.
I love it. Listeners, if you don't know what I'm talking about when I say Data Digest, it is it's a newsletter that we do every week that Will puts together, and he looks at some of the most compelling data that's out there in housing, and then does data visualizations around it. And it's really fun because those visualizations can give you more insight. Just I mean, the whole point of that is like so that you understand things at a different level by seeing it visualized. And he does a great job at that. So sign up for the Data Digest newsletter. And Will, thank you so much for being on and sharing what you found.
Thanks so much. Appreciate being here.